When you think about a successful fintech startup, you're probably thinking some sort of payment automation system or an online bank. And capital markets fintech is often considered being very niche. But in fact, there is so many different opportunities for digitization in the capital market space, and the industry may give rise to some very successful, profitable, and potentially scalable startups with attractive exit opportunities. And today I want to share 5 ideas of fintech startups inspired by the current state of the investment industry. In the professional investment management industry, there is such thing as automated alpha capture platforms. They enable professional research analysts that work for investment banks or registered broker-dealers to submit their best ideas in a standardized electronic format. And then buy-side firms pay for those ideas based on the research analyst's rating. Ideas include rationale, time frame, and the conviction level. And the platform allows buy-side firms to quantify and assess value of different trade ideas. On the opposite side of the spectrum, there are social trading websites. Basically social media for individual traders where they share and discuss their investment strategies and follow other people's strategies. So the idea here is to combine those two and create a platform for individual traders with top-level user experience and elements of gamification that could quantify value of trading ideas and facilitate contributors' compensation. And those trade ideas, and more importantly users' reactions to those ideas, could make a great data set that professional investors would be willing to pay for. Of course, building such a platform would require a lot of work from both technical and legal perspective, but once attracted enough users, it could easily become a billion-dollar valuation startup. Of course, you may say, wait a minute, there are so many different social trading websites and forums out there. That is true, but they're very segmented, and quite frankly, some of the most popular forums look a little bit like websites from early 1990s. Besides, Robinhood didn't really invent retail trading either, and yet they just raised another round of $320 million, and the entire valuation of the company is currently around $8.6 billion. Data labeling is one of the most important elements of building efficient deep learning models. You know how sometimes you fill out a form in the internet and then you get asked to identify a bus on 5 different pictures to prove that you're a human being? Well, this is called CAPTCHA, which stands for Completely Automated Public Turing Test to Tell Computers and Humans Apart. CAPTCHA is actually a very elegant tool for manually labeling data to train artificial intelligence algorithms, for example, for image recognition. And apparently, there are websites that provide capture entering jobs. They pay people a little bit of money every time they enter CAPTCHAs, and this way they get tons of people involved in manual data labeling. When big data is used for investment analysis, it is crucially important to have it linked to security identifiers. A lot of times it's being done automatically based on dictionaries, but that creates a lot of errors. Another example is ranking news by positive, negative, and neutral. Again, it's mostly done by natural language processing algorithms using dictionaries. But human beings are so much better at identifying less than obvious patterns such as emotions, expressions, sarcasm, humor. So the idea here is building a platform that compensates users for labeling market-moving news, blogs, tweets, and linking data to security identifiers. Professional investors would love this data set, and they would be willing to pay for it, especially if user base includes individual traders who understand the market and follow market-moving news. Once the platform gets to a certain point in terms of the user base, it will become a universal tool for labeling pretty much any kind of data set, not necessarily in finance, but also in healthcare, consumer goods and services, and more. And that makes it an idea for potentially scalable fintech startup. There's a common belief that alternative data needs to be necessarily very exotic or very exclusive, but in fact some free data from publicly available sources may be of a great interest and a great value for investment firms. A good example of that is RobinTrack, a website built by a student as a college side project, which is now extremely popular among multi-billion-dollar hedge funds. Another example is publicly available regulatory filings on the EDGAR database that are one of the most popular and widely used data source among hedge funds. There are many types of alternative data that can be collected online for free. However, processing this data into a usable format may take a lot of time and effort, and for that reason financial firms are willing to pay for ready-to-use data product with a few years of history. What it takes is to consistently collect and store data with timestamps, all the appropriate adjustments, and properly document the methodology. Once the initial setup is done, collecting data is a fairly passive process, so you can move on to the next data source. Such a business model of a nimble, flexible data collector is much more viable versus a data vendor that is focused on one specific data source, or a data aggregator that acts merely as a shopping window between buyers and sellers. Over the years, you can find yourself with a huge competitive advantage having high-quality historical data sample for a specific data set. And if something goes wrong with one of the data sources, the business is diversified in terms of both data sources and the client base. Because today alternative data is still mostly being used by a handful of professional investors, selling alternative data may seem like too niche of a business to build a scalable fintech startup. But in a few years, when alternative data gets democratized and becomes available in the more usable and affordable format to passive investment product sponsors and even individual investors, such an alternative data collector may become another billion-dollar valuation company. Quantitative hedge funds such as Quantopian or WorldQuant have been hiring remote research analysts for years. And in the current environment, for obvious reasons, such a crowdsourcing model becomes relevant to virtually every single asset management firm. And there's an opportunity in creating an independent, centralized freelance platform, sort of like Upwork for quantitative researchers. Employees don't need to be physically present at the office these days. And so financial firms don't really need to limit themselves by only hiring at certain locations. Many hedge funds made layoffs early this year, and they may not be quite ready to start hiring full-time. And freelance arrangements are much more cost efficient. Also, hedge funds get benefit of diversification by getting access to many different potential uncorrelated investment strategies. And the last but not the least, such a platform would allow talented quant researchers who don't have a lot of experience or big names in their resume to build their profile, to establish track record, and to potentially find full-time opportunities on the buy side or sell side. The freelance platform for quantitative researchers would need to facilitate contractual relationships, non-disclosure agreements, and compensation structures. There is also one specific question that such a platform would need to figure out, which is access to data. One way to do it that I can think of is for the platform to purchase enterprise licenses from data vendors and allow users to use this data on the platform to create and test their strategies. Now, if a hedge fund, a client of the platform, wants to purchase a model and validate it independently, they would need to also purchase their own data license. And this way, this platform would also become a great distribution channel for alternative data vendors. Both freelance platforms and crowdsourced alphas are proven business models. And the trend towards quantamental research in investment management, combined with the overall trend of remote work and gig economy, makes this freelance platform for quantitative researchers yet another scalable idea for a fintech startup. They often say that data is now becoming a commodity. And if so, it makes sense to start trading data as a commodity. And I'm not talking about multiple existing marketplaces or aggregators. I'm talking about an actual exchange that requires commodities to meet certain quality standards, that regulates contractual relationships between buyers and sellers, and that facilitates a transparent price discovery process based on supply and demand. One potentially valuable product of such an exchange could be, for example, a future contract on data, where the buyer could buy data at a specified price at some point in the future, for example, when enough history is available. This way, the buyer could lock in the price and the seller could get paid upfront. And if along the way, before the expiration, the buyer no longer wants the data, they can sell it to someone else at a secondary market. Another potentially valuable feature is escrow accounts. For example, if a buyer and a seller enter into a multi-year contract, the exchange would hold an escrow account and only release payments if the service continues and the data remains of the same quality as promised. Otherwise, the exchange would cancel the contract for a breach of agreement. The idea of such a big data exchange is by no means limited by the investment management use case. Investment banks, commercial banks, consumer goods corporations, media companies, they can all be paying clients and equity investors for such a venue. Capital markets fintech startups may seem less scalable and not so interesting for venture capital investors. But in fact, if you build a really valuable tool and figure out a viable business model, not only can it become sufficiently scalable, you will also get access to an additional pool of capital. Large hedge funds and investment banks have separate divisions to make private investments into promising fintech startups. If you have any thoughts of those 5 startup ideas, or you know someone who's doing that already, please let me know in the comments down below. And of course, subscribe to follow our Kane Alpha channel. I will see you in the next episode.